Welcome back to our channel. My name is Tony.
And my name is Linda.
In this video, we discuss the importance of having shared financial values in a relationship. It's important to note we're not psychiatrists, psychologists, or any other form of professional guidance counselor. We just want to share what's worked for us. It may not work for you. At the very least, this video will give you some of the things that you need to talk about before you get too serious in a relationship.
When you reach a point when you are ready to settle down and get married, it is especially important to find a significant other that shares your values on money. Marry a big spender and it may become impossible to reach financial freedom. Whatever your combined income, the big spender will spend. Money is the number one thing that couples fight about and the second biggest cause of divorce.
Some things to consider regarding financial alignment between couples include, will you have a joint checking and savings account? If it is separate, who will pay common household expenses? Will you hold assets jointly or in each name? What's your individual spend limit before consulting the other? Who will be your beneficiary? What's your combined comfort level with financial risk? What's your comfort level with debt? How much debt is each person bringing into the relationship? When do you want to retire as a couple? The list goes on, but it's important to talk about these things with each other. These are not conversations that you want to have on your first date, but make sure to have these conversations before you say, I do at the altar.
One recurring question is, should couples combine their finances when they marry? We think that is a very personal choice that involves many factors. It is easier for couples who are just starting out to combine finances when both have yet to establish any financial net worth. Those who have married later in life may have a larger financial net worth to consider. Again, it is a personal choice, but make sure you both agree before going forward. For us, we chose to combine our finances. Our thought was if we didn't trust each other, why would we have ever gotten married? Now that said, we know couples who seem to make separate accounts work. We decided early on in our relationship to tackle life together. That included our finances.
When we considered how we would hold title to property and other assets, we thought long-term. There are significant tax consequences related to how you hold assets and how you pass anything on to your beneficiaries. We consulted both a tax expert and an estate attorney. Not an easy choice when you're starting out and money is tight, but their advice was worth the cost. You give enough to Uncle Sam in federal taxes and to Aunt Salary in state taxes while you're alive. No sense in giving them any more than you have to when you pass on.
Set an agreed upon spending limit. When we started out, we agreed to talk to each other before making any purchase above $100. Your actual limit will vary depending on your income and net worth, but be sure to have a limit. We knew someone who brought home a new four-wheeler without talking with his wife. She was understandably upset and made him return it. That caused some discomfort in the relationship for a few weeks. Set ground rules and follow them. Strive to always be on the same page financially.
Talk about debt. How much debt is each person bringing into the relationship? When we met, we really didn't have much debt. In fact, we didn't have much of anything other than love for each other and a drive to become financially independent. Hopefully you both agree on the difference between good debt and bad debt. Any debt used to purchase non-income producing assets is a liability. Any debt used to purchase assets that don't produce a positive cash flow is risky. We discussed good debt and bad debt in our video titled How to Achieve Financial Independence. If you've not had a chance to review it, please do. Debt can keep you awake at night and cause serious stress in a relationship. Debt can also be a good thing if it's used to purchase rental properties that produce cash flow in excess of their expenses. However, you shouldn't take on any more debt than you can handle or feel comfortable with.
When evaluating the amount of debt we feel comfortable with, we typically look at debt to income as a ratio. We feel that it is a good metric as it is one of the metrics a bank looks at when they consider whether or not to lend you money. There are other ways to look at debt, including the total dollar amount of the debt, length before the debt is paid off, and so on. The method in which you evaluate debt may change as you get older. We don't know any 90-year-olds that think a mortgage payment on their house is a good idea. Part of financial planning is planning when you will be debt-free. Financial independence is achieved when your passive income exceeds your expenses. Eliminating debt can help you achieve financial independence sooner.
Another item to discuss is your combined risk tolerance as it relates to investments. As we shared, we like real estate investing, but we also like the stock market. We've made money in the stock market and we've lost money in the stock market. There are a lot of financial risk assessment tools out there. Your brokerage firm probably has one. We recommend that each person in a relationship take the assessment and then talk about it. If you are more or less comfortable with investment risk than your significant other, then work through it. You may decide to meet in the middle or limit your exposure risk to the lesser comfort level of the two. There's no right or wrong answer here. It's about consensus.
Talk about the specific resources you will use to manage risk. For example, there are mutual funds out there that adjust the asset allocation of your portfolio based on the year in which you expect to retire. Now, we are not endorsing these funds as most charge a larger fee than we feel comfortable with. We are only stating that they are out there if you want a fund that automatically reallocates as you age. Another method out there is to adjust the amount you have in stocks versus bonds based on your age. Essentially, your age would represent the percentage of bonds that you have in your portfolio. For example, at age 20, you would have 20% of your portfolio in bonds. At age 40, you would have 40%, and so on. With interest rates where they are these days, we're not sure that strategy is as valid as it once was. As we have noted in previous videos, however, we like low expense ratio broad market index funds.
Set goals and track your progress so you remain on the same page. Build a spreadsheet that includes all your assets, liabilities, income, and expenses. Use it to track your net worth. Update it the same day every month. Rather than overwriting any data, add a column for each new month. That will allow you to see your progress. Set short, intermediate, and long-term goals. Understand where you want to be 50 years from now and work backwards. Prepare yourself in advance for financial setbacks. Life happens. The stock market corrects, job losses happen, and people get sick and so on. Don't expect your net worth to go up each and every month for 50 years straight. It doesn't work that way. You'll have good years and you'll have bad years, but if you're making good decisions and you're disciplined, you will achieve financial independence. Don't get discouraged. Think long term.
Open communication is very important in any relationship. Talk about any differences in your communication styles. First, identify your communication style by taking an online quiz. Just search Communication Styles Assessment. There are many out there. Understanding your significant other's communication style will help you to better communicate with them. So many problems in life are created by poor or improper communication. Life can get hectic. Make time for each other. Talk about how to handle conflict when it happens. I say when instead of if here because no matter how equally yoked you are with your significant other, everyone has a bad day. The important thing is to try and listen to each other with an open mind and always be respectful during your conversations.
We recommend premarital counseling that includes candid conversations about finances. Don't wait until you're married to find out that your significant other has $250,000 in student loan debt, has filed for bankruptcy, or that they have a 500 credit score. Goal alignment is critical in a relationship. Working together, you can achieve so much more than you can independently. Choose a life partner that shares your financial goals. Work hard, earn more, minimize your expenses, save your money, and invest it so it works as hard as you do. If you like this video, please click the like button. Remember to subscribe to our channel where we talk more about life lessons. Thank you for joining us, and remember, work hard, spend less, save more, invest the rest. Thank you.